Good afternoon, students. Today we will be starting with the capital budgeting part, and we will be mainly covering the payback period method and the discounted payback period. So let's start. Capital budgeting in simple terms means the long-term investment which the companies make. It is known as capital budgeting. So budgeting decision is very important for an organization because it involves huge amount of fund. Okay, and whether the investment which we will be doing, it will give us the future benefit or not, we will have to analyze it, and we will have to compare, as the companies have various alternatives to invest their fund, and as it involves huge amount of fund, so we will have to be more careful in investing our fund. Okay, and as it involves huge amount of fund, that's why we cannot withdraw the investment which we have made, and even if we withdraw the investment, then the company will have to incur huge amount of loss. So this capital budgeting decision have to be made very carefully, and for that various methods are there, like we have traditional methods, payback period method, average rate of return method, we have discounted method like the net present value method, internal rate of return method. Yes, so we will be seeing all those. Today we will be studying about the payback period method. Okay, payback period is a traditional method of capital budgeting. Okay, through this method we try to analyze the initial cost of investment which we have made in a project, in how many years we will be able to recover the initial investment, whether we will be able to recover it or not. Okay, this method also does not take into consideration the time value of money criteria. So this is a disadvantage of the payback period method. So let us see how we will find out in how many years we will be recovering the initial investment. And the formula is initial investment divided by net annual cash inflows. This example says that the initial investment is 10 lakh. Yes, and the project A has even inflow of 1 lakh every year. That means 1 lakh we will be getting in every year. So what is the formula? Initial investment, which is 10 lakh rupees. Yes, and the net annual cash inflow in 1 year we are getting 1 lakh rupees. So in how many years we'll be recovering it? We'll be recovering it in 10 years. Understood? So this says that this 10 lakh rupees we will be able to recover in 10 years. Yes. Find the payback period of the project whose initial investment is 5 lakh 20,000. Project B has an uneven cash flow. That means in year 1 it is 2 lakh, year 2 it is 3 lakh. It is not even, right? So to find out the payback period, what we will be doing, we will be writing the year. We will be writing the cash flows which we will be receiving. The year is first, second, third, and fourth, right? And cash flows are 2 lakh rupees, then 3 lakh rupees we have got, then we have got 4 lakh rupees, right? And then we have got 1 lakh rupees. Yes, this is 4. Okay, so now we need to find the cumulative cash flows. We need to find the cumulative cash flows. Cumulative means when we add on all the cash flows. In the first year it will be 2 lakh only. Yes, in the second year 2 plus 3 it will be 5 lakh, right? Till third year we have got 9 lakh. 5 plus 4 is 9 lakh rupees. Yes, and in the fourth year we have got 10 lakh rupees in total. But we want to find out in how many years we are able to recover the 5,20,000 which we have invested. So till the second year we have already recovered 5 lakh rupees, and now we need to recover only 20,000. So to find out that in how many years we will be recovering, in second year we have already recovered 5 lakh, so we will be writing 2, the period before which we have recovered. Okay, then the remaining amount which we need to recover, that is 20,000, and this 20,000 we will be recovering from the 4 lakh which we will be getting in the third year, right? So we will be writing the 4 lakh rupees in here. Okay, 4 lakh. So it comes out to be 2 plus 0.05. Yes, 0.05, which turns out to be 2.05 years. 2.05 years we will be able to recover the 5,20,000. Yes, so this way you will be finding out the payback period. Discounted payback period. It is a variation of the payback period which we have studied earlier. Okay, in this method, the time value of money is taken into consideration for finding out the payback period in which the initial investment will be recovered. Okay, so to find out the cash flows which will be given to us, we will be finding out the present value of these cash flows. Okay, only then we will be seeing in how many years we will be recovering the initial investment which we have done. So to find out that, we have already studied how we will be finding out the present cash flows, right, in the time value of money chapter. So for doing that, finding out the discounted cash flow or the present value of the cash flow will be dividing the actual cash flow which will be given to us. Okay, the actual cash flow divided by the present value factor. Yes, whatever is given to us, say it is given as 10%, so it will be 1.10. Yes, to the power the years. If it is 2, then we will be giving 2 here, right? So this way we will be finding out the present value of the cash flows. Or what we can do, we can simply find out the present value factor and then multiply by the cash flow, like the cash flows which is given to us. Yes, into 1 divided by 1.10, whatever the rate is being given to us, to find out. So it is 1 and 1. This way we will be finding out the cash flows of the second year. Yes, if it is uneven, then 1 divided by 1.10 to the power 2. So this way we will be finding out and then we will be adding it up. Yes. So let's see a question then. How will we be finding out the discounted payback? So this question, the amount of cash flows expected from the new opportunity are, as initial investment has been given as 8 lakh and we have uneven cash flows. Okay, so we need to find out the simple and the discounted payback period. Okay, so and is the investment opportunity acceptable under the two methods? It has been asked whether we will be accepting this investment opportunity by using both the methods. Okay, and the maximum desired payback period of the management is 3 years. So we need a 3 years payback period. If so, let us see whether it fulfills the condition or not. And the present value has also been given. So first we will do the simple payback period. The method is that we will be writing the years first, then the cash flow, and then we will be writing the cumulative cash flows, right? So cumulative cash flow, when we find out first year, it will be 2,50,000 only. It will be 2,50,000. Then, and the second year, 4 lakh plus 2,50,000, it comes out to be 6,50,000, right? It comes out to be 6,50,000. Then in the third year, 6,50,000 plus 3 lakh, it is 9,50,000. But we need initial investment which will be covered in the between this year 2 and year 3, as the initial investment is 8 lakh and in year 3 it comes out to 9,50,000. That means between year 1 and year 2 our amount will be recovered, initial investment. So the formula is that years before full recovery is year 2 is 2 plus the unrecovered amount. The unrecovered amount is this 9,50,000, sorry, this 8 lakh minus 6,50,000. It comes out to be 1,50,000, right? 1,50,000 divided by this 1,50,000 we will be covering up from the next year cash flow, that is 3 lakh. Yes, cash flow during the year is 3 lakh of the year third. So 3 lakh. When we divide by 3 lakh, 1,50,000 divided by 3 lakh, it comes out to be 0.5. So the answer will be 2.5 years. In 2.5 years, our amount, this 8 lakh, will be recovered. Okay, so the condition was what was that the payback period should not be more than 3 years. In 3 years only, we'll have to recover it. So this, through this simple payback period, the investment will be accepted, as in 2.5 years only will be recovering the 8 lakh, the investment we have done, that is 8 lakh amount. Yes, so the project is acceptable according to the simple payback period method, because the recovery period under this method is 2.5 years, is less than the maximum desired payback period, that is 3 years. Understood? Okay, now let us see the next question. To find the payback period of the same question with the discounted payback period, we will have to first find out the year present value, right? For that, year and cash flow. Then we will be finding out the factor of 12%, right? Discounted factor of the 12%. And then we'll have to find out the present value of the cash flow. Okay. So here is first, second, third, and fourth. Cash flow has been given as 2,50,000. First is, and second is 4 lakh. 4 lakh has been given. Then third, we've got 3 lakh. This, and fourth one is 4,50,000. Right? 4,50,000. So to find out the present value of the cash flow, first we will have to find out the 12% factor, present value factor. Right? So that one will be doing 1 divided by 1.12 to the power, it will be 1 only. Yes, S is for first year. And for second year, we'll have to find out for 1 divided by 1.12 to the power, it will be 2, right? Then so on, it will be then 3 and then 4. Okay, and these comes out to be how much? It comes out to be 0.893. Okay, 0.893. This one comes out to be 0.797. 0.797. Here, this one will be, you will please find it out with the calculator. 0.712, and this one will be 0. It will be for 4 years. 636. Yes. So to find out the present value of the cash flows, what we will be doing, we will be dividing the cash flow with the factor. Okay, 2 lakh multiplied by this one, 0.893, it comes out to be 2,23,250. Okay, now 4 lakh into 0.757, it comes out to 3,18,850. No, 800. Okay, and 3 lakh into 0.712 is 2,13,600. Yes, and this one will be 4,50,000 into 0.636, it is 2,86,200, right? So this is the present value of the cash flows, but again we will have to find out the cumulative part, right? Cumulative present value of the cash flows. Okay, and that will be, this will be same, 2,23,000. Yes, 250 for the first year. Then for the second year, we will have to plus this will be 5,42,000. 5,42,050. Yes. Then for the third year, it will be 7,55,650. The fourth year, it comes out to be 10,41,400. But we need, our initial investment was how much? It was 8 lakh, right? So 8 lakh is been recovered between 3 and 4th year. So our formula says that year before full recovery is third year. Yes, before full recovery, as in the third year we have got 7,55,650, and then unrecovered costs at the start of the year. That means how much is not being recovered. So we will be finding out by 8 lakh minus the 7,55,650. It comes out to be 44 lakh 350, right? This we have find out by the initial investment minus the 7,55,650. Okay, this is the remaining amount which we will be recovering. Okay, in the between this third and fourth year, and this amount we will be recovering from this present value of the cash flows. This for fourth year present value. Yes, and that comes out to 2,86,200, right? And when we divide it, we get 0.15, that is 3.15. So we will be recovering our amount in 3.15 years. But what was the condition? The condition was that our investment amount should be recovered within 3 years, right? But here it is exceeding, so we will reject this project. Okay, with both the methods it should have been less than 3 years or 3 years, only then it would have been accepted. Understood? I hope the payback period questions are clear. If it is not clear, please ask me. Okay,